Good morning, your financial independence viewers, where we're always trying to grow your financial independence. So, today we're going to be going over kind of like my goals of what I'm trying to do in the stock market. What are my future plans, future moves? Where am I trying to go in life exactly? As you can tell by the name of the channel, Financial Independence, the FIRE movement. I do love that strategy, just mainly because I would rather sacrifice, not even sacrifice, I still live, like, we still go to the lake all the time, we have a boat and stuff like that. I would rather save on some of the luxury items now, invest that. That way, 10 years from now, whenever I do have children, a lot more life events happening, I would rather not have a job and let my money grow and work for me and pay me. Doesn't look like I'm ain't gonna be retiring anytime soon. Not just kidding. So as you can see today, we're down just like every other day this week. It seems like, and last week, we're down 1.92% right now. Hollion's down 2.82. Tattooed Chef 2.5. People that are selling Tattooed Chef basically because their CFO is leaving. It's so overrated right now. Dropbox is down 0.80%. Chewy is down 2%. And Palantir is down 1.60%. So the goal that I did have for myself this week going into next week, which I already accomplished, I wanted to be 100% margin free. That way, as you see now, the buying power that is, so I actually have $923 just kind of sitting in there. I may use a little bit of that, or I may try to build up cash right now. Margin available 41,755. So get into why I am saving up right now instead of buying the dip. I know that's a super big kind of like controversy that you're supposed to always buy the dips. I've kind of been thinking to myself, look where a lot of these Palantirs, the Chewies, a lot of the SPACs like Tattooed Chef and Holion, look where they've been going, I don't know, this past basically month or a couple weeks at least. And look at where the S&P 500, NASDAQ, Dow Jones Industrial Average is. So they're all at record highs right now. Basically, they're very, very valuing the future of the economy. I am expecting a pullback, and I know that's not always the wisest decision, is to not buy the dip and try to like forecast what's going to happen in the short term. But I do expect a lot of these stocks, Palantir, the Chewies, and I could even see Holion and maybe Tattooed Chef going down. Dropbox is pretty stable. I want to have a lot of capital ready. That's one thing I do regret. I was super new. As you may know, I started investing around February of 2020. So basically right before the market crashed. And I had to do a lot of learning. I had to stay really strict to, I try to follow, Warren Buffett the most I can, his kind of investing strategy. So I had to be really strict on myself not to go after all of these high flying stocks and stick to what I know and try to, keep a steady annualized return instead of, yeah, you make a couple 100% one year, but you keep on doing these short-term option strategies and all this other stuff that's been happening. It's just not a long. You're not going to be very successful in the stock market in a long period of time. I'm talking about over 10, 20, 30, 40 years. So I did complete my goal. I am totally margin free right now. And I'm happy with the stocks that I do own right now. I wish that I did own more Chewy. I started buying in like the $40 range. That's the only stock that I don't have all the way filled out that I do want. So this is basically my game plan that I am going to show y'all. Go to the investment calculator. It's calculator.net. You can basically pull this up anywhere. In all of my accounts right now, I roughly have around 65,000. And let's just say, I don't know, an average time is around 15 years. And you can go with an 8% rate of return every year. That's if you're investing. That's the average, for the past 100 years in the S&P 500, which is the safest bet. But I do love picking individual stocks. I love reading articles, reading the 10Ks, reading 10Qs, and really finding like the needle in the haystack that has a very good valuation for the potential growth that it's going to have in the future. Yeah, you could say 40% rate of return, but there's going to be some bad years. We could experience that this year, the way the market is so richly valued right now, which is kind of why I am holding out a little bit. Now, if we have the rest of this week and next week stocks continue to fall, I'm going to start putting capital in. I mean, I'm not just going to avoid this whole dip buying period, but I've been buying the dip this whole time. And yes, stocks are getting cheaper, but in the short term, I know it's really, really, you shouldn't really think about the short term, but I really strongly feel like the market is going to go down, and I'm happy with all the positions I do have. Besides Chewy, I didn't have a high enough conviction at the time when I started nibbling at the stock. When I fully understood what they're actually going to be doing in the pet industry and e-commerce, it was already too late. It was already shooting past 70, past 80. So we're going to do a rate of return around 25%. Let's just see where that takes us. That's annual. And right now I am putting $2,000 in the market every month, but just for safe bets, $1,500. You never know when you have life events that should pop up, and that's why you should have an emergency fund. So, as you see here, 65,000, 15 years if I stay exactly what I'm doing, or I'm far exceeding 25%, but 2020 was a special year. We're exceeding 25%, even though with this nice little downfall we've been having. And with investing $1,500 per month, that comes out after 15 years to be $4,038,896.18. I know you might be thinking that's totally unrealistic. You're not going to get a 25% rate of return, all this other stuff. So let's just say you barely beat the S&P 500. Let's just say 12%. That's very realistic. So after 15 years with a 12% rate of return, $1,500 a month, you're going to be looking at $1 million, $62,968.52. We'll just round that out to $1,050,000. We'll even be more conservative. Go ahead and take off whatever, basically $13,000 that would be off of. So my plan is to, once I get to where I'm comfortable, I want to transfer the majority. I still love my growth stocks. Obviously, as you can see, I love tech. But we can more transition that into a dividend payer, a more blue chip kind of stock. And you can make your own portfolio of stocks, but a really good one that I have been looking at, I've been thinking about making a dividends only account. So we'll go with Verizon, and let's see the PE ratio 13.56, basically the biggest 5G provider. The dividend yield is 4.26%. So let's see. Let's pop up a calculator. So 1,500,000, and then we're going to times that by, let's just say 0.04. So you're going to be pulling in $40,020 a year. This is just your money working for you. This is only the dividends that they are paying you. And yes, you are going to have to get taxed on that. So we'll say $40,020. Single individuals. So you're going to be in the 12% tax bracket range. So you're going to take that $40,000 a year basically that you're going to be getting from only dividends, and you are going to have to pay taxes on that. So on the federal tax bracket, you're going to be at around, or you're going to be right now, as is, 12% for your income tax. That's going to be $35,217 a year. And this is only including just the dividends that my goal is to build out a dividend portfolio, so more stocks than Verizon. But we're just taking this as an example. I've just been looking up on the stock. It's a really, really attractive risk reward. It's not really that huge growth. It's not going to be growing like a Palantir, in my opinion, or a Tattooed Chef is going to be in the future. As you can see, it's got its ups and downs, but I mean, you're still going to be beating inflation. Over the 5 year period, they're still up 13.61%. So your money is going to be still doing a little bit better than inflation, and you're going to be getting $35,000 a year. And you can constantly add up to this. Like if you had that $4 million, if you were getting a 25% return, I mean, we're talking about over six figures. So that is my plan as of right now. Just know we're always hoping for your financial independence. See y'all.